All right, welcome to another episode of Looking at the Markets with me, David Modell. All right, today's topic is where should I set my stop loss orders? Not everyone uses stop loss orders. If you are going to use them, I hope that you're not setting them randomly. You need to decide before you buy a stock or option where you'll sell if the trade goes against you, as well as where you'll sell if the trade goes in the right direction. A good rule of thumb is to give 3 times as much upside room as downside room. So before making a trade, you'll first need to decide where your stop loss will be. This will be a number slightly below the purchase price. Here's the purchase price, and here's where you'll put your stop loss order. The distance between the purchase price and the stop loss order will represent the maximum amount of money that you're willing to lose on the trade. It should it should represent a small fraction of your total trading account. A reasonable guideline for most people would be 5% of your trading account, or better yet, less than that. Okay. If you want to make it 1%, that's great. 2, 3, 4, 5% at most. Anything more than that, and you might be taking unnecessary risk, depending on the size of your account and your situation, of course. But 5% or less on any trade is a pretty good, safe guideline for most traders in most situations, at least in my experience. At the time of purchase, use a stop loss order to set this limit. So when you make the purchase, go ahead and at the same time or right afterward, set that stop loss order. By doing this, you'll be establishing your maximum loss on the trade, which is this amount from here to here. You'll also want to place a limit order at the price where you'll be selling if the trade goes in the right direction, which is right here. That's where you'll sell, and that's a limit order if things go your way, which hopefully they will. So you take the distance between the purchase price and the stop loss order. I'm sorry, the purchase price is here and the stop loss order. You take that distance and you multiply it by 3. And then you add the purchase price. That's where you'll set your stop loss order up here. In other words, the distance between the purchase price and where you'll sell if the trade goes in the right direction, so the distance from here to here, I should say, is 3 times as large as the distance between the purchase price over here and where you'll sell if the trade goes against you. So this distance is 3 times as large as this distance. To put it yet another way, let your winners run 3 times as far as your losses. With this 3-to-1 ratio, you're cutting your losses short and letting your winners run. So let's go over an example. Let's say you purchase a stock and the stock ticker is XYZ. So you buy it at $200. So you set your stop loss, let's say at 195. All right, so you decide beforehand that you're willing to lose $5 on the trade, because that's a small percentage of your account, 5% or less. Now you'll set a limit order to sell if it reaches 215. That's $5 of room to the downside and 3 times as much, yes, that's $15 of room to run to the upside. Then you can just leave the trade alone if you want to. and let your conditional sell orders do all the work for you. Sooner or later, you'll either profit $15 to the upside or lose $5 to the downside on the trade. The toughest part for many people, emotionally speaking, the toughest part is having the tenacity, the stick-to-itiveness to let the winners run. So let's go back to that same example. You purchase stock XYZ at $200, set your stop loss at 195, and then you've got your limit order to sell if it reaches 215. You have to be willing to honor both of those conditional sell orders. Resist the temptation to take profits on the way up. Yeah, resist the temptation to take profits early when it hits 208, 210, 212, etc. Let your winners run all the way. Sure, the trade could turn around and head back toward 195. That's a possibility that you'll need to accept beforehand. Just accept that, yeah, it could run up to, in this example, it could run up to 210, 212, even 214, and then head right back down and take out your stop loss at 195. That could happen, and you'll want to accept that possibility before you even make the trade. For many people, the best approach is to set the conditional sell orders after making the purchase, of course, and then walk away for a while. Let the stock go wherever it wants to go. Let it run its course. After all, you have no control over that aspect of it. This hands-off approach can reduce the temptation to meddle with your predetermined conditional sell orders. By adhering to this 3-to-1 ratio, you'll have big winners and relatively small losses. This means that after you make a large number of trades, and assuming that you use small position sizes for each trade, like I told you to do, even if you're right only a third or 33% of the time, at least theoretically, you might still at least break even. And hopefully you'll be right more than 33% of the time on your trades. At least I hope so. So used properly, stop losses can add a measure of safety and enhanced profitability to your trading system. This in turn can lead to more money in your account and, just as importantly, a better night's sleep. If you need more help with this or with any aspect of trading or investing, feel free to contact me. My email address is davidmodell@gmail.com. Hope to hear from you soon. Talk to you next time.